So investors somewhat muted in their reaction to nvidia. Of course, it had another blockbuster quarter. The stock, as of today, up almost 50% in the past year. Revenue soaring more than 70%. But the forecast not thrilling investors. Let's get perspective on the tech mega caps in general and AI from Christine Tan, portfolio manager at SLGI Asset Management. Christine, great to see you, and thanks very much indeed for joining us.
Good morning, Andy. Good to be here.
Maybe we could have a quick look at nvidia and the pre-market. We didn't see a huge reaction to the numbers. Did anything jump out for you?
No, I think you summarized it really well. The numbers are very, very strong. And Jensen actually spoke about visibility into about $700 billion of spending related to AI CapEx this year, which is very strong. I think it really is about high hurdle of expectations. NVIDIA's done really well over the last 3+ years. So at this level, it's not as expensive perhaps as it was a year ago, but I think there's just a bit of this view from investors. And this is one of our key investment themes this year. It's just kind of looking out beyond the few core AI names to think about what the next beneficiaries are. But more importantly, who's being disrupted. There's also a little bit more caution around what we call CapEx fatigue. So on the one hand, $700 billion in AI CapEx is good for NVIDIA. On the other hand, what you're seeing is typically free cash flowing tech companies are starting to issue debt in order to fund these multi-decade type of investments. So there is a bit more kind of nuance in how investors are viewing a space where a year, 2 years ago, these kind of numbers would have been shared.
How are you guys playing the Mag 7 stocks now? Broadly speaking, are you overweight, underweight?
So our managers, especially the ones in the U.S., are there. They're quite selective on which companies within the AI space to own. One thing that they've been watching very closely is just valuations. So definitely not sort of overweight the complex, but there are a couple of names that they like from a relative risk reward basis where they would have a larger position. And there are a couple of names where they might not have a position at all because of valuations or perhaps some concerns around the visibility of how long these earnings can continue to grow at.
Broadly speaking, what is your equity allocation? I know your portfolios differ, the investor objectives differ, but are you overweight U.S. stocks right now, Christine?
We are neutral to our strategic weight. What we've been talking about since the start of 2025 is to really look for opportunities globally. So we're not saying that we're trimming U.S. exposure, but really allocating the incremental dollar to global equities. And it's a combination of global markets sort of having been a bit more slow in seeing the earnings recovery coming out of the lockdown and the reopen of the global economy. And also valuations are much more attractive globally. So that's been how we've been positioning the portfolio, neutral on U.S. But within the U.S., what's interesting is that year to date, the performance has been quite muted. But just like that duck on the surface of the water, there's been a lot of rotation underneath the surface of the market. So really kind of thinking more carefully about diversifying and broadening out the exposure in a more nuanced way versus maybe 2 years ago, where it was a much more concentrated market and also a much more concentrated global allocation to U.S. equities.
Broadly speaking, U.S. stocks that you guys think are not that cheap. So even when earnings beats come in, we don't see a huge upside reaction.
That's right. That's right. So we're about 92-93% way through the S&P 500's earnings season. So call it pretty much done. And it's been a pretty strong quarter. 74% beat their earnings expectations. So in aggregate, earnings are coming in about 7.5% higher than what consensus was going into the season. So by all means, that's a very strong report card. But again, as you highlighted, and we've been talking about, just valuations are quite elevated, and so expectations are quite high. So the hurdle for the market to continue to reprice upwards is now higher. But again, if you look at the underlying dispersion, though, in terms of sectors, which sectors are driving the earnings beats, you're seeing more industrials, a little bit of contribution from consumers, although even within consumers and industrials, there's a lot of dispersion in terms of which specific companies are doing well and which companies are perhaps facing a little bit more of a challenging outcome. And you can really see that in the consumer space. We know that, statistics show us that the top end consumer is doing very well. Although you are seeing some switch down, so we've been hearing that comment from Walmart, for example, that they're benefiting a little bit from consumers switching down to more value-oriented, that maybe consumers that didn't used to shop at Walmart as much before, but very nuanced. That's the term that we've been using, being very specific in terms of exposure and not making big, broad calls in general. And we're seeing that come through in the earnings, that very specific outlook, depending on the business and where that company sits in the value chain.
What about the Canadian banks? We got three big beats, a pretty strong quarter overall for the Canadian banks. Yeah, are you overweight those right now?
So our Canadian managers they do like the banks, and they do have a slight overweight to the banks. Starting about a year and a bit ago, they were starting to see the provisioning cycle bottoming out, not quite improving yet. And of course, we're nearing the end. We're not quite there yet. We're about 3 quarters away, 4 quarters away, but we're nearing the end of the worst of the rate reset for mortgages. So what I mean by that is, if you think back to 2020, 2021, when mortgage rates were very low, anyone that had a 5-year mortgage back then, you're starting to reset it today at higher interest rates. But we're getting close to that end of the cycle now, where rates are normalizing, and that change from the reset will no longer be as great. So that is a benefit, a net benefit for consumers. That's also a net benefit for banks. And we are seeing more of a fiscal response from the Canadian government in terms of spending, in terms of investment. And that in aggregate is positive for economic activity. On the other side, the employment picture is still quite soft in Canada. So it really is a combination of not necessarily being very bullish on the banks, but it is that they've done a good job managing their balance sheet through this cycle, and that provisioning sort of moderating and really bottoming out.
Thank you very much, Christine. Christine Tan, Portfolio Manager at SLGI Asset Management.